Hi, welcome to Search for Yields, the fortnightly newsletter from INR Bonds. I am Arjun Patsati. And after a long period of seesawing back and forth, a lot of news flows, positive, negatives, finally it's happened. India's bonds are getting included in the global bond index. I'll explain to you what it means to the bond markets in general and what it means to investors and financial advisors alike, as they look to position their savings and portfolios in fixed income and other markets in general as well, because it's an overall impact on the economy as well. Before that, if you're a financial advisor, the best place for you is INR Bonds Partner Portal. Check the best bonds on offer, curated especially for you with all the information that you need and the best price discovery and the best of transaction processes for your clients through the partner portal. All transactions are done through the clearing house of stock exchanges, and INR Bonds is a SEBI registered online bond platform provider. Log into INR Bonds and register yourself as a partner. And investors and advisors looking for curated list of bonds can download QuickInvest by INR Bonds, the mobile app for iOS and Android. Check the best bonds offered shown in the platform and straight through in-app investment process. All you need to do is make sure that you are investing in the right bond at the right time, taking the right decision based on the information that we provided on the bonds. And it's just a click of a button, the safest of investment processes. And back to the inclusion of India's government bonds in the JP Morgan Bond Index, Emerging Market Bond Index. Now, this has been going on for a while, and there's been a lot of news flows, headlines. Government has talked about it in the budget. RBI is continuing to talk about it. And finally, after a lot of back and forth from the government and the index providers like JP Morgan, India's government bonds are going to be listed in government bond index. Now, it's like for an equity investors who does not understand a bond index, it's very similar to a Nifty ETF index, Nifty 50 index. So when a stock gets included in the index, then all the investors of the index now will have to invest in that stock. Similarly, when a bond gets included in an index, then investors will have to invest in the bonds. And because India is now included in the global bond index of JP Morgan, then all the investors who follow the index will invest in Indian government bonds. Now, this has been a long time coming. India's government bond market is one of the largest in the world and highly liquid in India itself. But India as a rule did not go to the global sovereign bond markets to issue bonds. So this prevented a lot of foreign investors to invest in Indian bonds. They had limits available to invest in Indian bonds in India in rupees, but that was not. But that limits were not very high and a little cumbersome process. Now, with this inclusion, there will be a lot more interest in that global investors. All they need to do is benchmark the index and invest in the government bond, Indian government bond, as per the weights included. And now this has many potential positives. Negatives are also there, which I'll explain to you. On the positive side, clearly, one is that government is the largest borrower in the country. Every year they borrow from 15 to 16 trillion rupees, or including state governments, close to rupees over 20 trillion. That is 20 lakh crores over they borrow. And because of this, if there are more outside investors coming in to buy the bonds, the borrowing program can go through smoothly without any problems. And this can also ease very large investors like banks and insurance companies to not forcibly take government bonds, and can help them either invest in corporate bonds or other bond products, which can help private sector issuers. Now, all this is can technically what we call a crowding out effect of bonds or government borrowing. The government is a very large borrower, then typically the private sector gets crowded out. And if the private sector gets crowded out, they do not get funding at reasonable rates. And that prevents a lot of capex in the economy from growing itself. But now with this starting to happen, then private sectors can access the bond markets and borrow at very reasonable costs. That's one very big positive which can happen. The other is that there'll be a lot more interest trading of government bonds now with more liquidity coming in. The government bond market will get a very large thrust. And once the government bond market is getting large thrust, it'll filter down corporate bond market and all other bond products that are associated with the corporate bond like bond market. There could be, then you could have more bond ETFs coming into the country, corporate bond ETFs, government bond ETFs, more interest in investments. There could be a lot more bond products like REITs, InvITs. All these are very critical for the government. A lot of government capex can go through entities like NIIF, National India Infrastructure Fund, that is the only issues bonds for their borrowing. All this will find a lot of liquidity. And more importantly, bond platforms like INR bonds will offer a lot of good variety of bonds to retail investors. And they can invest in bonds, which gives them the best risk return profile for their investments. Financial advisors will have a larger product base to deal with, and they can actually access a highly liquid markets for their clients, for bond markets. So a very good positive sign for the country, especially this has been going on for a while. And due to various reasons, Indian bond were not included in the index. But most of the reasons are now being taken care of, like JP Morgan said. We have met all the criteria except the tax. But I guess that's a negotiation process between the government and the index providers. More importantly, while once the Indian bonds are included in the JP Morgan index, then other index providers like Bloomberg and others will MSCI and many others can include bonds, Indian bonds in their indexes as well. And that will lead to much larger absorption of government bonds by foreign investors. On the immediate reaction of markets where 10 government bond yields came down, 10-year gsec yield came down by about 9 basis points to 1.1%, showing that the reaction itself shows that it's a positive reaction, though the whole inclusion is going to start only from June of next year, and it will slowly go up in terms of weights. And the rupee also strengthened a bit, again showing that markets view this as positive, not negative. But having said that, there is factors here that Indian government has to be very conscious about managing its fiscal deficit, managing its borrowing, managing inflation in the country. And if there is more scrutiny on the Indian government, how it manages its macros, and if the government actually lives up to that scrutiny and does a good job of managing all the macros, then it's going to really help the government economy grow, equity markets will be up, rupee will be stronger, government bond yield will be down, more private sector borrowings, more corporate bond depth in corporate bond markets, and a lot of other bond products that can come from this. And all this is going to make India's bond market one of the most hottest bond markets in the global space. Thank you very much for listening in. Do tune into INR Bonds YouTube channel. And if you're not subscribed to the channel already, please do so.